May 6th, 2010, 2:42 in the afternoon. Over the next 36 minutes, almost $1 trillion in market value is going to simply vanish. Not in a war, not in a banking collapse. On an ordinary Thursday, the Dow drops nearly 1,000 points in a matter of minutes. Accenture, a company worth more than $30 billion, briefly trades for a single penny. Procter & Gamble loses a third of its value in seconds. And no human being decided any of it. And then, almost as fast as it fell, it comes back. Within minutes, most of it never happened. For years, investigators try to explain it, and the trail leads somewhere absurd. A 30-something man trading from his parents' house in a quiet suburb of West London. His name is Navinder Sarao. The press will call him the Hound of Hounslow, and from a back bedroom, he's firing thousands of enormous sell orders he never intends to honor, then yanking them away. It's the perfect villain. One man, one bedroom, $1 trillion. Except, that's not what happened. Sarao didn't cause the flash crash. The courts were careful with their words. He contributed to it. Because the thing his fake orders crashed into wasn't a market full of people. It was a market full of machines, all running the same playbook, all ready to sell at the very same instant. And here's what should stop you. This had happened before, in 1987, in 1998, and it is about to happen again, with the most powerful machines we have ever built. For 40 years, every time a market has come apart in minutes, it hasn't been a human panic. It's been automation. Thousands of machines, all doing the exact same thing at the exact same moment. One man saw the pattern coming. He taught the math. Then he ran the most powerful financial regulator on Earth. And he's been telling us, in plain words, how this story ends. This is the 40-year glitch. So let's start with the thing almost no one explains. Why do machines crash markets? Not broken machines, good ones, doing exactly what they were told. The answer is a single word. Hold on to it for the next 10 minutes. Monoculture. Think about what a market actually is. At its healthiest, it's an argument. Millions of people and strategies, all disagreeing. Some think a stock is too cheap, some too expensive. And that disagreement is the safety net. Because when a price falls, somebody out there decides it's now a bargain and steps in to buy. That buyer is what catches a falling market. Now take the people out and hand the trading to automated strategies. That's fine, until the strategies all start thinking the same way, trained on similar data, reacting to the same signals, the same brain copied 1,000 times. Now a shock hits, and every one of those machines reaches the identical conclusion in the identical millisecond. Sell. There's no one left to disagree, no buyer. So the price drops, which trips even more automated selling, which drops it further. A feedback loop running faster than a human can blink. And here's the trap underneath it. Wall Street looks at thousands of separate funds and calls it diversification. Lots of different players, spreading the risk. But if they're all running correlated strategies, that's an illusion. Underneath, the whole system is quietly holding one enormous position. And when it moves, it all moves together. That's the glitch. It isn't a flaw in any single machine. It's what happens when every machine is the same machine. And it has worn 4 different costumes. In the 80s, we called it portfolio insurance. In the 90s, it was the most decorated minds in finance. In 2010, it was raw speed. And today, it's artificial intelligence. Let's go back to the first time the machines did this. 1987. October 19th, 1987. Black Monday. In one trading day, the Dow Jones falls 22.6%. To this day, it's the worst single-day drop in the history of the index. Nothing in 1929, nothing in 2008, nothing in 2020 comes close. And the culprit was a product that sounded like the opposite of danger. It was called portfolio insurance. The pitch was beautiful. You're a big pension fund. You're nervous about a crash. So you buy a computer program that protects you automatically. If the market starts to fall, the program quietly sells stock index futures on your behalf, locking in your gains before it gets worse. A seatbelt for your portfolio. For one fund, it works fine. But watch what happens when everyone buys the same seatbelt. The market dips just a little. Thousands of these programs notice at once and all begin to sell. Automatically, mechanically, no human in the loop. That selling pushes the market down further, which tells the programs to sell even more. The seatbelt has become the crash. The official post-mortem, the Brady report, found something that should sound familiar by now. The wave of selling didn't come from millions of panicked investors. It was concentrated, in the report's own words, in surprisingly few institutions. On that one Monday, just 3 portfolio insurers sold around $2 billion of stock, plus futures worth nearly $3 billion more. A handful of machines, all obeying the same instruction. Now, let me be precise, because it matters for where this is going. Portfolio insurance was not artificial intelligence. No learning, no neural network, no model of the world. Just one blunt rule. Market down, sell. It's the great-grandparent of today's AI. But the failure, the monoculture, the feedback loop, the machines feeding each other, that was already fully formed in 1987. We did learn one thing. After Black Monday, the market got its first emergency brake. Circuit breakers. Automatic timeouts that halt trading when a fall turns violent, so the humans can catch their breath. Remember that break. It comes back. But first, the smartest people who ever tried this. If 1987 was a dumb rule gone wrong, this is the opposite. The most brilliant minds finance had ever assembled, undone by their own brilliance. The fund was long-term capital management. Its founder, John Meriwether, was a legendary bond trader. But the stars sat on the board. Myron Scholes and Robert Merton, Nobel Prize winners, authors of the most famous equation in finance, the formula that taught the world how to price risk itself. Their models were elegant. They found tiny, almost invisible gaps between prices that should move together and bet, with enormous borrowed money, that the gaps would close. For 4 years, it was a money-printing machine. The smart money begged to get in. And then, in August 1998, Russia did something the models had rated very nearly impossible. It defaulted on its own debt. And this is the deepest reason machines crash markets. Deeper than any single mistake. A model learns from the past, but a market is not a fixed system. The rules themselves change. Quants have a word for it: non-stationarity. The world quietly shifts into a regime the model has never seen, and in that instant, every relationship it trusted breaks at the same time. Prices that had always drifted apart suddenly slam together. The impossible becomes a Tuesday. In a matter of weeks, long-term capital lost around $4.5 billion and was staring at zero. And because half of Wall Street had lent it money, it threatened to take everyone down with it. Now watch exactly what the Federal Reserve did and didn't do. It did not spend a single public dollar. It facilitated. It put 14 banks in a room and pressed them to rescue the fund with their own money. As Alan Greenspan told Congress afterward, and this line matters, no Federal Reserve funds were put at risk. A near miss. The system survived. And everyone swore they'd learned the lesson. A model is only as good as the world it was trained on. 12 years later, the machines were faster still, and they handed us the 36 minutes we opened this story with. We'd already forgotten. Which brings us back to the man from the very beginning. His name is Gary Gensler, and his career is almost suspiciously well suited to this story. 18 years at Goldman Sachs, then into government, helping write the rules after the 2008 crisis. Then, something unusual for a Wall Street veteran. He became a professor at MIT, where he actually taught a course on artificial intelligence in finance. Then he was named chairman of the Securities and Exchange Commission, the most powerful financial regulator on the planet. And today, out of the SEC, he's back at MIT, co-running a lab on exactly this: AI and finance. So when this man warns you about AI and markets, He is not guessing. In 2020, before he ran the SEC, he co-wrote an academic paper with a quiet, alarming title: Deep Learning and Financial Stability. He'd already seen the shape of it. And in October 2023, he said it out loud to the Financial Times, in words a regulator almost never uses. A financial crisis caused by AI, he said, is nearly unavoidable within a decade, unless we act now. Why? Because of a detail most people miss. The most powerful AI models on Earth come from a tiny handful of companies, which means thousands of banks and funds and lenders are about to be making their decisions on top of the same 2 or 3 models, fed by the same data. Sit with that. That is not diversification. That is portfolio insurance, but for the entire economy. The same monoculture that broke the market in 1987, rebuilt with the smartest machines we've ever made. Here's exactly how he put it. I do think we will, in the future, have a financial crisis. And in the after-action reports, people will say, aha, there was either one data aggregator or one model we've relied on. And he is not a lone voice. The Bank of England warns that AI could push firms into, their phrase, increasingly correlated positions, amplifying shocks. The Global Financial Stability Board says the system now leans on a small number of key suppliers and admits, honestly, that regulators can't yet even measure the risk. The pattern is 40 years old. The machine is brand new. So step back and look at the whole shape of it. 4 crashes, 40 years, 4 different machines, a simple selling rule, a Nobel-winning model, high-speed algorithms, and now artificial intelligence. And here's what I most want you to take away. Not one of them was evil. Not one was even broken. The math was mostly correct. The danger was never the math. The danger is the monoculture. The moment everyone is running the same brain, and the market loses the one thing that has always saved it: somebody who disagrees. But that's only half the story. And the other half is the hopeful one. Because here's where that break comes back. Every single time the machines have done this, we learned, and we built a new one. 1987 gave us the first. Circuit breakers, the market's emergency brake. Automatic timeouts that halt trading when a fall turns violent. The 2010 flash crash gave us finer ones on every individual stock. A complete recording of every order placed in the market. And a brand new crime, spoofing, the very law that finally caught the man in the Hounslow bedroom. 40 years, 4 crashes, and after every one, we reached for the brake. Everyone but the next. Because the brake for AI, the one rule Gensler's SEC wrote to start reining in AI on Wall Street, was drawn up and then, in 2025, withdrawn. For the first time in 40 years, we can see the next crash taking shape, and we're standing right next to the brake, still deciding whether to pull it. So the real question was never, is AI dangerous? We already know the answer. Every powerful tool is. The question is the one we've answered 3 times before and are hesitating on now. Do we build a market of many minds or one? That's the choice in front of us. Not whether to use these machines. We will, and we should. Used well, they make markets faster, cheaper, and fairer. The choice is whether we insist on diversity over monoculture, on daylight over black boxes, on brakes over blind speed. Because the machines were never the problem. The monoculture is. And whether the market of the 2030s is built from 1,000 different minds or just one, that was never up to the algorithm. It's still a choice, and it's still ours to make.